Hello, economics students. Today we're going to talk about taxes. You'll need to pay real close attention to this short presentation today because you will need the information here in order to figure out how to do today's assignment that's in Canvas. So let's get started. We'll begin with some definitions related to taxes. So first of all, gross income. Gross income is your total income before there have been any deductions taken out of your paycheck. So for example, if you get hired for a job and they tell you that you're going to make a salary of $50,000 a year, $50,000 is your gross income. If you have a job that pays wages by the hour, your gross income would be your hourly wage. My gross income is, for example, $10 per hour. That's gross income. Next comes taxable income. Taxable income, of course, is the income that's subject to your income tax. Now, why is that different than gross income? Because there are certain savings plans that people have that are tax deductible. So what happens with taxable income is you take your gross income and reduce gross income by tax deductible savings accounts, and that gives you your taxable income. Tax deductible savings accounts are things like an IRA, which is an individual retirement account, or a 401k plan. These are all basically retirement programs that reduce your gross income to a lower taxable income. So taxable income is that income after the tax deferred or tax-free savings plans. Then comes disposable income. Disposable income is what you have after your savings deductions are taken out and after your taxes are taken out. This is the income that you actually see on your paycheck. That's what you get to put into the bank and use however you wish to use it. Disposable income, and as you can see, the dollar signs get smaller with each one of these. So obviously then disposable income is what you see. That's what you get to enjoy for the fruits of your labor. Now let's talk about different types of taxes. Income tax is tax on your income. Simple enough. Tax on earnings. Sales tax is taxes on things that you buy. So typically in Illinois, that's about 10% on most purchases. You'll have about a 10% sales tax. And then we have property tax. I don't have this on the slide, but basically property tax is assessed on real estate, and real estate would be the land and the buildings on the land that you own. And you can also have property tax that is on personal property. Personal property taxes would be taxes that you have, for example, on an automobile. When you pay for your annual license plate tag that you stick on your car, that's a personal property tax. And then, of course, when it's your land and the house that you live in, that is real property tax, real estate. A few more definitions. A proportional tax, that's tax rates that are fixed at a specific percent of income. So this means that, for example, if you make $20,000 a year and you pay 15% of your earnings in income tax, you could also make $2 million a year and also pay the same rate, 15% on your income. So a proportional tax, it doesn't matter what your annual earnings are, you're going to pay the same tax rate regardless. There are also progressive taxes. High income earners would pay a higher tax rate than low income earners in a progressive tax scheme. So for example, if I'm only making $20,000 a year, I might just pay 5% income tax on my earnings, whereas if I make $200,000 a year, I might pay 20% on my earnings. And if I make $2 million a year, I might pay 35 or 40% on my earnings. So that's a progressive tax rate. The higher your income, the greater percent of your earnings that'll be taxed. And finally, you could possibly have a regressive tax where low income earners actually are taxed at a higher percentage rate than high income earners. That might sound pretty crazy and unfair, and it probably is a little unfair, but we might find out that there are actually some taxes that exist in our society that are in fact regressive, where low income earners pay a higher percentage of their income in the tax than high income earners do. So that would be a regressive tax. So with that, let's get into how we calculate the tax rates. When we do calculations to determine what our income tax rate is, we're going to use gross income to do that. So here's how that's going to work. We're going to use base tax rates on total gross income. And as I say here, in the real world, it's not quite that simple, but we're going to keep it simple. So to calculate your tax rate, you would take the amount of tax that you pay divided by your total gross income. So for example, if I pay $18,000 in income tax and my total gross income is $100,000 per year, then that means I would be paying an 18% tax rate. 18,000, of course, is 18% of $100,000. And we can do this with all types of taxes. We can do this with income tax, property tax, sales tax, all types of taxes. We can always calculate what the tax rate will be, and we'll do that again using the tax that is paid divided by your total gross income. So keep this information in mind as you do your assignment today that is in Canvas. And with that, I'll stop this presentation and you can get to work on your assignment.